Okay, we are recording. Hi there, everybody. We are doing this recorded lecture for the second half of chapter 9, where we talk about the perpetual inventory system. So on the first recorded lecture for chapter 9, we went over the periodic inventory system and how we use and record with some of those different accounts. Sales returns and allowances, purchase returns and allowances, and some of those other accounts that we talked about, freight in. And so now we're going to learn the entries using the perpetual inventory system. And so there are a few differences with the perpetual inventory system, but the main difference is that we don't use the purchases account. Under the perpetual inventory system, we just use merchandise inventory. We don't call it purchases, we call it merchandise inventory. And then we don't use freight in. If there are freight charges, those are debited to merchandise inventory, just like the purchases essentially. And then also with perpetual inventory, we do not use purchase returns and allowances. If something is returned, it is just credited to merchandise inventory. So a few differences. And then also, and probably the biggest difference is that with each sale, we record cost of goods sold also. So there's a cost of goods sold that gets associated with each transaction also. So we'll look at that and then of course get some practice together, hopefully a little bit of practice together in the recorded lecture, and then of course practice together when we're in class. And I was just starting my timer, so I know how long this is. So okay, I am going to share my screen with you, and then we'll get the remainder of the chapter 9 PowerPoints pulled up. And so we went over, basically, 1 through 32, slides 1 through 32 for periodic inventory. And now we're going to finish up the rest of this with the perpetual inventory system. So perpetual inventory, again, the inventory system is being continuously or perpetually updated. Every time we purchase inventory, we're debiting merchandise inventory. Every time we sell inventory, we're crediting merchandise inventory. So again, that inventory system is being updated after every transactions, right? So using the general journal and the perpetual inventory system, we're going to record sales and sales related transactions, record purchase and purchase related transactions, just like we did in the periodic system. And as we discussed before, that this perpetual inventory system keeps a continuous record of inventories by recording all transactions as they're happening. So if you think about when you go and purchase something from Walgreens, for example, that POS terminal or that point of sale terminal that they use, that cash register, that automatically updates, both the sale of the transaction and then also updates the inventory account. Since that item was just sold, it reduces the inventory account. And so that's what we're looking at with the perpetual inventory system. So here's our first example, and I don't know why I have not started the slideshow here. So here's our first example. So this one, August 8th, it said sold merchandise on account to Green River Rafts, invoice number 9385 for $1,116. Cost of inventory sold is $948.60. Again, this cost of inventory sold, which is also known as cost of goods sold, this cost of goods sold is new with the perpetual inventory system, right? We did not use this account, this cost of goods sold account, under the periodic inventory system. So this is new to us. So with this transaction, with the perpetual inventory system, we have to record not only the sale on account. So we sold merchandise on account, as we know, and as we see here, That's a debit to accounts receivable, a credit to sales revenue, right? And so that's to record the sale. This is to record the sale, right? But then we also have to record the fact that now our merchandise inventory is reduced because we just sold some of it, right? We just sold $1,116 worth of merchandise. So we have to reduce our merchandise inventory. So remember, merchandise inventory is an asset account. So we reduce it by crediting it. So to record the cost of goods sold, we're debiting cost of goods sold, crediting merchandise inventory. So again, that cost of goods sold is increasing. Cost of goods sold is a type of expense. You know, this is what we paid for this, whatever we sold, I guess a raft or whatever we sold. We sold some inventory to this. We paid $948.60 for this inventory, and then we sold it for $1,116, right? So we're debiting cost of goods sold. That's is essentially is treated like an expense on the income statement. And then we credit or reduce merchandise inventory since we just sold some of it. And then as we're going to see too, and as we go through, if we take our sales minus cost of goods sold, that gives us gross profit, right? They talk about that in the book. I know we all read this chapter. So in this case, if we took our 1116.00 minus 948.60, we've got gross profit on this sale, 1116 minus 948.60. We've got gross profit on this sale of $167.40, right? And so we'll see once we get in chapter 11, chapter 12, once we get back to preparing the income statements and the financial or the income statement and the other financial statements, that this is how we calculate gross profit, right? It's the sales minus the cost of goods sold equals gross profit. All right. On this example, it looks like some merchandise is being returned. So on August 14th, Whitewater, oh goodness, it looks like there's a little typo in there. Marty's Fly Fishing Adventures returned $250 worth of merchandise that had a cost of $215.90. So when we return some merchandise, just like we saw with the periodic system, we're debiting sales, returns, and allowances, right? Here's our debit, sales, returns, and allowances, and we're crediting accounts receivable. There's our credit, right? So when something is returned, merchandise is returned, we're still debiting sales, returns, and allowances. We're still crediting accounts receivable. But again, you can think, you know, we've got to put this merchandise back on our shelves. We've got to add it back to inventory, take it away from cost of goods sold, since in fact, it's not sold now, it's been returned. So that's where we have now this debit to merchandise inventory, credit to cost of goods sold. And so if we go back real quick, again, when we sold the merchandise, we debited cost of goods sold, we credited merchandise inventory, right? When we sold it, we debited cost of goods sold, we credited merchandise inventory. When it's returned, it's just the opposite. We debit merchandise inventory, credit cost of goods sold. Anyway, we'll get some practice doing them together. It just, you know, takes doing several of them and getting comfortable with it. They're not too bad, I think. All right, so here's another example. It says record the following transactions for North Company in general journal form. North Company uses Perpetual inventory system. So on July 6th, sold merchandise on account to Dean Company, $2,240.25. Cost of inventory is $1,950.30. Okay. So we're going to end up, remember, having 2 journal entries for each transaction. For each transaction, we got 2 journal entries, one to record the sale and one to record the cost of goods sold, right? So on this one, this is where we're going to debit accounts receivable, credit sales revenue. And then this amount, the cost of goods sold, this is what we're going to debit cost of goods sold, credit merchandise inventory is what these are going to look like. And we'll see it on the next slide. And then July the 8th, Ryder Inc. returned $475 worth of merchandise purchased on July the 1st with a cost of $230.25. So, you know, again, this is the amount that's being returned, but this is the cost of those goods, right? All right, so if we look at these transactions, again, here's the 6th. So here's our first one to record the sale, right? That's to record the sale, debit to accounts receivable, credit to sales revenue. This one is to record cost of goods sold and take it away from inventory. So debiting cost of goods sold, crediting merchandise inventory. And then when some of this merchandise is returned, then we are debiting sales returns and allowances. Here's our debit. Debit sales returns and allowances, credit accounts receivable. So that takes the money out of accounts receivable off of what the customer owes. But now we've got to put it back into inventory. So then we've got the debit here to merchandise inventory, credit to cost of goods sold. And again, up here is when we're selling it, that when we sell it, it's a debit to cost of goods sold, credit merchandise inventory. But when we're putting it back into inventory because the customer returned it, we're putting it back into inventory. This is where we're doing the opposite. We're debiting inventory, crediting cost of goods sold. Anyway, we'll get some practice with it together once we get started on our exercises. All right, so here's a few examples, or a couple examples anyway, of some purchase transactions. So it says, all transactions related to the purchase of inventory are recorded in the merchandise inventory account. So we do not use freight in. We just consider those costs merchandise inventory costs, right? So, you know, looking at this first example, not only are we going to be debiting merchandise inventory for the amount of the sale, but also the freight costs. So we're going to debit merchandise inventory for the total, right? We don't have a separate freight in account. So we'll look at the example of that on the next slide. And then on August the 10th, bought merchandise on account from Lang, Seth and Son, $2,772. Let's see, terms net 30. So the invoice is due in 30 days. FOB Cleveland. So that's FOB destination. Freight prepaid and added to the invoice, 157. So again, we don't have a separate freight in account. So we're going to take both of these numbers added together, and we're going to increase merchandise inventory, debit merchandise inventory for that total amount. Okay, so that's what we see here. You know, again, we've got the debit to merchandise inventory for the whole amount, the credit to accounts payable for the entire amount, the whole amount. Same thing on the 10th. We're debiting merchandise inventory. That's increasing, right? Merchandise inventory is an asset. Assets increase with the debit. So we're debiting merchandise inventory, crediting accounts payable. All right. So there's no freight in account. No freight in account, right? Remember, periodic inventory, we use that freight in account. This one, we have no freight in account. We just charge it to inventory. Whatever the shipping costs are, they just get charged to the inventory amount. All right, purchase returns. So I mentioned this at the start of the recorded lecture that with the perpetual inventory system, we do not use the purchase returns and allowances account, right? It's not used. We do not use purchase returns and allowances. When merchandise is returned, it is just decreases the cost of the inventory, right? So on this example, it says on September 8th, Whitewater Raft Supply returned some merchandise and received a credit memo from Dana Manufacturing Company for $270. So it reduces what we owe. So we're debiting accounts payable. We're reducing what we owe Dana Manufacturing Company. We're crediting merchandise inventory, and that's reducing inventory. So we're returning 270 worth of inventory to Dana Manufacturing. And so Dana Manufacturing is reducing our bill by that amount, and we have to reduce inventory by that amount, right? So that's a debit to accounts payable. That's going to reduce what we owe Dana Manufacturing, and a credit to inventory, which reduces that inventory account. All right, so this kind of highlights the differences between periodic and perpetual inventory. Remember, with the periodic inventory system, we're using purchases, purchase returns and allowances, freight in. With perpetual inventory, we do not use that. We use just cost of goods sold account, and then merchandise inventory, right? So anything that's returned gets credited to merchandise inventory. So just some of the differences there between those two. Of course, we've well, we've got practice with the periodic inventory entries. We're going to get practice with perpetual inventory entries. Not too bad, just a few differences. This out of your book also shows you, or kind of highlights the example, or some examples rather, of the differences in the journal entries. I was trying to find the page number for you. This is on page 388. So if you want to look back at this, I'm not going to go through every line here. But again, it shows you what the transaction would look like with the periodic system, and then what it would look like with the perpetual system. So that's maybe a good thing to kind of study. You kind of see here that we've got the freight in account, we got the purchase returns and allowances account, we got the purchase. Remember, we don't use those in the perpetual inventory. Perpetual inventory, we use this a cost of goods sold merchandise inventory account. Freight charges are charged to merchandise inventory. Purchase returns and allowances are reduced in merchandise inventory, reduces the cost of the inventory. So just some of those differences you can look through. All right, the end of this chapter, the last part of this chapter, talks about some of the special journals that are used in some situations. You could kind of think about these like we talked about in previous chapters as the subsidiary ledger accounts, right? We kind of think about these like the same way. So if we keep a sales journal, for example, the sales journal is used to record only sales on account, right? Only when we sell goods or products on account. And so what we do is we keep a sales journal, and maybe our sales journals for 1 month, and we keep the transactions individually in the sales journal. And then at the end of the month, we take the total amount and post that to accounts receivable and sales revenue, for example, right? So it's like a subsidiary journal or subsidiary account that we use. Again, thinking about the sales journal, when we have a sale on account, then we would be debiting accounts receivable, crediting sales revenue type thing, right? And so what the sales journal does is, again, if we have 25 sales through the month, instead of doing, 25 different transactions here, we would just keep the total in our sales journal. And at the end of the month, we would do one summary transaction to both of these control accounts, right? Same thing with the purchases journal. If we keep a purchases journal, maybe our purchases journal we keep every month, and then we do the summary entry once a month. So purchases journal is used to record purchases of merchandise on account. And so usually with our purchases we've got maybe some freight charges in there, what have you. The example of this that it shows in your book, and I think we actually see one as we continue through the slides, but the purchases journal they show on page 392. And on the purchases journal, they show columns for accounts payable, for freight in, and then for purchases also. So anyway, it's on page 392 if you want to look at that. I think it shows us an example in here. The cash receipts journal used to record all transactions that include a debit to cash or an inflow of cash, right? And cash payments journal used to record all transactions that include a credit to cash or cash disbursements. All right, so here's an example of some information that we might have on our sales journal. And like we said, transaction will call for a debit to accounts receivable and a credit to sales, right? So debit accounts receivable, credit sales revenue. And so looking at these 5 transactions, if we were using a sales journal, each of these transactions would be recorded in the sales journal. And that at the end of the month, we would total them all up and we would do one summary entry to accounts receivable and sales. And so I'll show you what I mean by that on the next slide. So looking here at, and again, these correspond, for example, Mesa River Raft Company, 1933.50. Here it is, Mesa River Raft Company, 1933.50. So those correspond to the previous slide. But if we add these up now, 1933.5 plus 1116 plus 1594 plus 552.3 plus 1674. This gives us a total of 6869.80. And so if this was all, or if these were all of our transactions for the month, at the end of the month, we could do a summary entry and record these in a summary entry. And that would be, like debit, accounts receivable, 6869.80, credit, sales revenue, or sales, simply sales. 6869.80. So that's what we mean by a summary entry, right? When we use these journals, we would use the journal, for example, for a month. And then at the end of the month, we would come up with the total. And that's what we would do, this one summary entry. Instead of doing, 5 or what, 1, 2, 5 different entries like this, we would just do one summary entry. All right, and that's what it's showing us here. So then you see, here's the debit to accounts receivable. Here's the credit to sales, just that summary entry that's done. And just like it shows here, that posting from the sales journal saves time and space in posting to the ledger account, summarizes 1 month's transactions instead of posting single entries of debits to accounts receivable, credit to sales, to these accounts for the amount of the total as the last day of the month, right? So we post the summary entry at the last day of the month for the total amount. All right, sales journal with sales tax payable. If we've got sales tax payable, then instead of, let's go back real quick, instead of having, because it shows us here, accounts receivable debit, sales credit, instead of just those two accounts being impacted, when there's sales tax, we got 3 columns being impacted. So we still got the debit to accounts receivable, we still got the credit to sales, but then remember with sales tax payable, we also have a credit to sales tax payable. So, same thing with this sales journal. We would just do, all our transactions throughout the month would be recorded in this sales journal. And then at the end of the month, we would total up each of these columns, and then we would do a summary entry for each of those columns at the end of the month. All right, purchases journal. Again, we talked about this one, and it follows along those same lines with the sales journal, and then that we want to, instead of making several entries into the purchases account or the merchandise inventory account, if we're under the perpetual system, instead of making several transactions, and I guess this is really only applicable to the periodic inventory system, but instead of making, several different journal entries into it, we can make one summary entry at the end of the month, right? So based on these transactions here, we're going to look at the purchases journal. And so the purchases journal is also a 3-column journal. And so we're going to have a column for purchase amount. We're going to have a column for freight in. And then we're going to have a column for accounts payable is what we're going to see with this. So, you think about the purchase amount, this is our purchase amount. This is our freight in amount. And then this is the accounts payable amount. Looking at each one of those. Anyway, we'll see this on the next slide. So here's an example of that purchases journal. Again, we would come up with the totals for each of these columns. And so what, 1795.5 plus 2929 plus 564 plus 2606. So we've got 7894.5 total for this column. Freight in 85.5 plus 157 plus 102.3. So this total 344.80. And then finally, the last column, 1710 plus 2772 plus 564 plus 2503.7. We've got 7549.70. So we're going to credit accounts payable for this amount. We're going to debit freight in for this amount, debit purchases for that amount. A summary entry instead of 4 different entries here. And so that's what it's showing us here. Again, we see that credit to accounts payable, and then the debit to purchases, the debit to freight in. So not too bad. We can kind of think about these special journals, like I said, similar to like subsidiary ledgers, where The transactions from our special journals make up the total amount in our control account, or the total amount that we're recording in the control account, right? All right, these are some of the practice exercises that we're going to do. I've got a couple ready for us in Excel. So I'm going to stop sharing this and get Excel pulled up. Hi, guys. Okay. So let me pull up Excel now. All right, so the first one we're going to do exercise 9-7, and I'll try to make it as big as possible so it's easier to see. So 9-7, it says record the following transaction for a perpetual inventory system in general journal form. And so letter A, sold merchandise on account to Southridge Manufacturing, $1,815.24. The cost of the merchandise was $1,320. So if we get this, and I'm folding my screen back real quick, maybe that'll make it easier to write these. Okay, so sold merchandise on account. So remember, there's two journal entries. We need to do one to record the sale and then one to record cost of goods sold. So the first one, we would debit accounts receivable for this customer, Southridge. 1815.24. We would credit sales revenue. So that's the first one, to record the sale. And then the second one is to record the cost of goods sold. So that'd be a debit to cost of goods sold. 1320. A credit to merchandise inventory. $1,320 is what that one would look like. All right. And remember, I did mention in the PowerPoint. So thinking about gross profit, remember the formula for gross profit is sales minus cost of goods sold equals gross profit. So on this particular sale, if we took 1815.24 minus 1320, let me get my calculator here. So 1815.24 minus 1320. That means we got gross profit on this sale, 495.24. Anyway, okay. Let's go to the next one here. Issued credit memo to Southridge Manufacturing for merchandise returned, $622. The cost of the merchandise was $485. So again, two entries. The first one is where we debit sales returns and allowances, credit accounts receivable. The second one is where we put it back into inventory, basically. So we've got the first entry, debit sales returns and allowances. $622. Credit accounts receivable for this Southridge customer, $622. And then we also have to put, because the merchandise was returned, we've got to put it back into our inventory. So for that, we debit merchandise inventory. 485 credit cost of goods sold. $485. And so if we think about it, the original sale to this customer, if we scroll back up here, the original sale was 1815.24. And now the customer has returned 622 worth of merchandise. So now they only owe us what? They owed us 1815.24 minus, now they only owe us minus 622. So now they only owe us 1193.24 still owed. Hopefully that makes sense to you. All right, here's another one, letter C. This one says bought merchandise on account from Michael's 850, terms 1/10 in/30 FOB Dallas. So that's FOB destination, FOB destination on, in this case, again, we don't use the freight in account. So on this one, we're just adding those freight costs to our inventory. So bought merchandise inventory on account, we're going to debit merchandise inventory for the total amount because we don't use freight in. So we're debiting merchandise inventory for $915. That's our total, right? The 850 plus the 65 total is $915. I don't know why it did this, but okay. And then crediting accounts payable. Now we owe who? Michael's. $915 is what that one would look like. We don't use freight in, so that those freight charges just get debited to merchandise inventory. All right, the last one on this one, received a credit memo from Michael's for merchandise return $210. So, we bought merchandise up here just on this transaction. We bought $915 worth of merchandise. Now we're returning some of it. So it's going to be the exact opposite of letter C. In letter C, we debited merchandise inventory. We credited accounts payable. Now we're returning some of it. So it's going to be the exact opposite. We're going to debit accounts payable for Michael's. How much? 210. We're going to credit merchandise inventory. It's going to be the exact opposite of letter C because with the perpetual inventory system, we don't use purchase returns and allowances. It just gets, recorded right into merchandise inventory. So again, thinking about this, we owed Michael's $915. Then we just returned $210 worth of merchandise. So what? Now we only owe $705. Hopefully those make sense to you. Of course, we're going to get some more practice in class. I got one more picked out for us to do in this recorded lecture. And so again, this just gives us practice with some of these different transactions. And so our first one here says, or this problem rather, it says, prepare journal entries to record the following merchandising transactions of Cabela's, which uses the perpetual inventory system. So purchase merchandise from Bowden Company for $6,000 under the credit terms 1/15 in/30 FOB shipping point, invoice dated July the 1st. So, we're purchasing inventory on account. So this is debit merchandise inventory. $6,000 credit accounts payable for these people we owe now, or this company we owe $6,000. All right, the next one, letter B, sold merchandise to Creek Company for $900 under the credit terms 2/10 N/60 FOB shipping point, invoice dated July the 2nd. The merchandise had a cost of $500. So remember on this one, we're selling merchandise. So we're going to have two transactions. We're going to have one journal entry to record the sale, and then we'll have another journal entry to record the cost of goods sold, right? So the journal entry to record the sale, debit accounts receivable for, who is this? Creek Company. So we got a debit accounts receivable, 900. Credit sales revenue, 900. And then we also have to record the cost of goods sold. This merchandise had a cost of 500. So debit cost of goods sold, 500. Credit merchandise inventory, is what that one would look like. The next one, letter C, paid 125 cash for freight charges on the purchase in letter A. So again, we don't have a freight in account with Perpetual inventory system. We just add those costs to the cost of merchandise inventory. So debit merchandise inventory. How much is it? 125. And we paid cash, so credit cash, 125. All right, letter D, sold merchandise that had a cost of $1,300 for $1,700 cash. So again, we've got two transactions here, two journal entries. We've got to record the sale of $1,700 cash, and we've got to record the cost of goods sold, $1,300. So debit cash, 1,700. Credit sales revenue, 1,700. And then the cost is 1,300. So debit cost of goods sold, 1,300. Credit merchandise inventory, 1,300. Right, two transactions there, one to record the sale, one to record the cost of goods sold. All right, letter E, purchase merchandise from Light Company for $2,200 under credit terms 2/10 N/60 FOB destination, invoice dated July the 9th. So we're purchasing 2,200 of inventory. Inventory is an asset, so we're debiting merchandise inventory. $2,200. Crediting accounts payable, $2,200. And then purchase merchandise inventory, $2,200. Yeah. Yep, that's all we need for that one. Okay. And then the last one, received a $200 credit memo from Light Company for the return of a part of the merchandise purchased up here. So now we're returning some of this purchase. And so it's going to be the exact opposite. We're going to debit accounts payable. And I forgot to put this person's name or that company's name. So we're going to debit accounts payable for Light because we no longer owe $2,200. We returned $200 worth. So we're debiting accounts payable, crediting merchandise inventory. 200. Okay. So, again, you think about, we owed Light 2,200. We just returned 200 worth of goods. Now we only owe them 2,000, right? Is how that will work. Okay. We are about at our class time. Let's see. Let me check the timer and see where we're at. Well, we're at 43 minutes, I guess, about 43 minutes. But anyway, that's what I wanted to practice with you, to get practice with some of those. And then we will continue in class together. Hopefully that helped out. Hi there, everybody. Hello again. All right, and we will continue this in class. Bye, guys. See you soon.